Alright, are you confused about what to choose? Stocks, mutual funds, or ETFs? Don't worry. By the end of this video, you will know exactly how they differ and which one is the right fit for you. So, let's dive right into the video. So, the number one thing, what these terms mean in simple words, right? So, the number one term is the stocks. So, basically, stocks represents the ownership of a company. For example, when you buy a stock, you own a small part of that company. Let's suppose in a scenario, you buy shares of TCS or Reliance. You became a part owner of that company, right? These stocks can be traded directly also into the stock market. You can trade or can you can sell, buy, or you can trade in future and options, whatever you can. You can buy, you can do trading in delivery or intraday, whatever it is suitable. So now the number second point is what are mutual funds? So basically mutual funds are like a pool or are like a basket of investment that are managed by professionals. There are thousands, there are hundreds of professionals who have expertise of their own, and they are sitting on their desk to manage your money. For example, there is a pool of investors like you, all retail investors, that pull up all your money and give to that fund manager. And that fund manager decides where to invest it, right? Whether in stocks, whether in commodities, or whether in other bonds or in other assets, right? So these are called the mutual funds. So the number third point is ETFs. And this is now a quite interesting term. So ETFs are generally like mutual funds only, but they trade on the stock exchange also. Yes, mutual fund cannot be traded, but ETF can be traded, just like the stocks. They combine the diversification of both mutual funds with the flexibility of stocks. Number second thing is what are the key major differences between stocks, mutual funds, and ETFs? So the number one thing is ownership and control. If you go with the stocks, you own individual companies and can decide which one to buy or which one to sell. But in mutual funds, you are not relying on the company. You are basically relying on the fund manager to make those decisions for you. Whether the fund manager is choosing the right stock or not, or buying at the right time or not, or selling at the right time or not. It is totally dependent upon the fund manager. And what are ETFs? Basically, the difference of these ETFs with these stocks and mutual fund goes upon the diversified as an asset. This comes both with the functions of stocks and functions of the mutual funds, right? The key difference of the ownership and controls goes apart, and next comes the cost, right? Stocks usually have a brokerage fee, right? So when you trade in stocks or you do intraday in stocks or you do option trading in stocks, you have to give brokerage to the broker on which you are trading. So in mutual funds, charges an expense ratio, right? Which is a fee for managing your money. It means that the fund manager is managing your money, and in return, you are giving to the fund manager some amount of money, right? And ETFs are also have an expense ratio, but it's often lower than the mutual fund. Likely, it again comes with the functions of stocks and mutual funds. It comes exactly on the middle of both, right? So, number third is risk and diversification. So, in stocks, basically are high risk and can give also a high return. It means that where there is high risk, there is possibility of also chances of high growth. But if you choose the right one, you can be a gainer, or if you choose the wrong one, you also can be a loser, right? And so the number second is mutual funds. So mutual funds offer instant diversification. So when you are choosing a mutual fund, it is already coming with a large amount of stocks. For example, you choose one fund where under that fund 30 companies comes. And so there is very less chances of going your money to a false or in a wrong way. And the third most important thing or the interesting thing that comes is the ETFs. ETFs also offer diversification, but the risk depend on their type of ETF. So for an example, if you buy a large cap company's ETF and if you buy a small cap ETF, right? So the movement or the flexibility will always be a differentiable difference, right? So if you see one day large cap is moving 1%, then the other day you will see small cap is moving 2 or 4% even, right? Because the small cap companies are more volatile than the large cap companies. Number 4 is the flexibility. Flexibility of the stocks can be traded anytime during the market hours, right? So in the time of the market hours, you can trade the stocks at any time. Mutual fund, however, are bought and are sold at the end of the trading day based on the NAV or the net asset value. So NAV is likely the share price of a company. So for an example, if one company is valuing 100 rupees, it shows the price of that stock, and the NAV also shows the price of the fund, right? So number third section that comes is which one now you should choose. Which one is right for you? It depends on your goals and preferences. Yes, choosing stocks, if you want to control over your investments and are willing to do the research, then you should go with the stocks that gives more returns and of course high risk. But if you are going with the right research and right analysis, then of course stocks are more beneficial in long term. So number second is, if you are choosing mutual fund, if you prefer a hands-off approach and want professional management, then always go with the mutual fund. Because you, for example, you don't have any time, you are doing a 9 to 5 job, you do not have any knowledge about stock market, or you cannot give time on researching the stocks and other investments. Just buy the mutual fund and trust the fund manager. They will keep your money safe. Third is choosing ETFs. If you want to mix both stocks and mutual fund, diversify as ETFs because they are basically a mixture of stocks and mutual fund. So the bonus tip that comes at last is, before you invest, here are a few tips that to always keep in mind. The number one thing is always assess your risk tolerance and financial goals. It means that you should always pre-decide that what should be your risk, that you are willing to take risk, that this much amount of money, if it goes into the stock market, or this is the money that whatever it can happen, like it can go away due to loss, so due to that it should not affect me. And always pre-decide your financial goals, that at what time I will exit and what time I will entry. These are the pre-deciding things that you have to do before entering the stock market. Number second thing is, don't put all your eggs in one basket. It means just simply diversify your portfolio. It means that do not keep all your money in one single stock or in one mutual fund. Always keep, if you are having investment in equities, in stock market, in stocks, then always diversify into 5 to 8 stocks. So the number third is understand the fees and expenses involved in. So there are many mutual funds that their expense ratio is much higher, and that is not affordable. Exactly, this is why many people avoid mutual fund due to expense ratio and exit load. Of course, they are not willing to exit at that time, but due to some emergency, they have to exit, and due to that, they are penalized in a heavily exit load. Right? So avoiding these things can be more beneficial in long term. Right? So these are the three bonus tips that I want to give you. Number at last is the conclusion. Now that is it for this video. I hope this simplified explanation of stocks, mutual fund and ETFs helps you make smarter investment decisions. Remember, the best investment is the one that aligns you with your goals. So if you found this video helpful, give it a thumbs up, share it with your friends and subscribe to Dealing Dolphins for more financial insights. See you in the next video.